Okay, and welcome back, students who are taking financial accounting. In this series of videos, we are working on the assigned homework problems from the digital study guide for Chapter 8, the Group B exercises. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. Now, as a quick aside, and I mentioned this in the previous two videos, we're looking at assets, and assets are going to depreciate. Okay. Now, you've learned depreciation if you've had math for business and finance or math applications. And it's also covered here in the financial accounting textbook. So if you don't understand depreciation methods, then go back and watch the theory videos in financial accounting, and that will also give you the web address for the student community under the business group, the math for business / application section, which has a thorough explanation of the theory for depreciation methods. Right? When you're working with an asset, you're going to end up depreciating. Now, the reason why I'm taking this moment here is because, I'm not going to be repeating stuff that should already be known. Right? You should already know this stuff. So if you don't know it, then you need to go back and review and learn it again, because I'm only going to push forward. Where I noticed in like the last video, we're talking about disposal of assets. Well, as part of the disposal of an asset, you have to calculate your depreciation. And I'm not going to go over that, which we've already covered many times before. All right, so I want to focus more on the intent of the exercises, which is like making journal entries for the disposal of an asset. Okay, so if I'm going to work through the problem, but I'm not going to explain what I'm doing when I'm doing the calculations for the depreciation. I'm going to concentrate more on the appropriate concept that we're trying to learn at this moment in time. So go back and watch those videos, the theory videos. If you have leaks in your thinking, plug up those links. Because if you don't, then it doesn't matter what you're doing with the disposal. You can't get if you can't calculate the depreciation correctly. Okay. So with that said, I'm going to move on to number 39 here. All right, let's see here. It says disposition of long-term assets. Assume that Hardigan Corporation's comparative balance sheet reported these amounts. Okay, plant and equipment less accumulated depreciation. These are the nets for the different year. Okay, assume on January 2nd, 2014, right? Hardigan sold half of its plant and equipment for $252,000 in cash. Journalize this transaction for Hardigan. Okay, so this is very similar to the previous problem here. Okay, so if you need more experience, or you need a second look at exercise 8-38B, right? Because we're going to sit here and we're going to say, okay, they're selling half of its plant and equipment, so the sales price is going to be $252,000. Okay. Now our book value is our cost, right? And our cost for at the end of 2013 was $645,000. Well, we're selling half of that, so we divide by 2, and that means our cost is $322,500. Okay, and we have accumulated depreciation that needs to be taken into consideration. And the accumulated depreciation is 175. So we divide that by 2, and that means we're depreciating 87.5. So our book value ends up being 235,000, which is what we subtract from the sale price, and that gives us a $17,000 gain on the sale. Now, making the journal entry, right? If you watched the previous video for problem 8-38, you saw that I take it in sort of like different steps. So number one, I ask, what do I gain? Well, I gained cash, right? What did I get? I got cash, and we're getting cash in the amount of 252,000. So I debit my cash. Now, what am I giving up? Well, I'm giving up half of my plant and equipment and half of my accumulated depreciation. In other words, I have to reverse entries, for my general ledger accounts. So if my cost is 322,000, right? That's a debit. So that means I'm going to credit my property, plant, and equipment for 322,500, and I have to reverse my accumulated depreciation. Well, that's the normal balance of accumulated depreciation is a credit balance. So that means I'm going to debit my accumulated depreciation for 87,500. Now, that was like number one, what did I get? Number two, reverse my, what am I giving up? Okay, what am I getting rid of? And then number three, as part of my step process, is I say, what's my debits? What's my credits? Okay, and in this case here, the difference between those two is this 17,500, right? Remember, I had said in the last video, I had said I don't memorize whether I have whether a loss is a debit or a gain is a credit, because transactions like these happen they don't happen every day. Okay, they happen every few years, and you're not going to remember, whether a loss is a debit or a gain is a credit, because honestly, and when you look over the entire scope of accounting, you're going to have gains and losses in different places, and depending upon where those gains and losses are, one is going to be a debit, one's going to be a credit. You're never going to remember which one is associated with which. So it's easier to just say, okay, I add up my debits, I add up my credits, what's the difference between the two, which is the 17,000, right? And in this case here, to make my journal entry balance, I have to credit my gain on sale for $17,000. Okay, and that's my journal entry. All right, it's just that simple. All right, as long as you follow the process. All right, so go back and watch exercise 8-38B to see me, work through it, in that particular problem, and then of course, pause and rewind this video in order to see the process, applied again. And on how to be able to think through what, recording that disposal of the asset. Okay, all right, so moving on. And if you still don't understand, feel free to contact an instructor. Okay, but again, calculating depreciation, you should already know that. The whole idea is how do I make this particular journal entry? All right, 40. Trade in on purchase of a new asset. Okay, Maple Valley Transport is a large trucking company. Maple Valley Transport uses the units of production method to depreciate its trucks. In 2013, acquired a Mack truck costing $385,000 with a useful life of 6 years, or 1,500,000 miles. Estimated residual value is $85,000. The truck was driven 182,000 in 2013, 263,000 in 2014, 254 in 2015. After 62,000 miles in 2016, Maple Valley traded the Mack truck for a new Freightliner that cost $422,000. Maple Valley received a $243,000 trade-in allowance for the old truck and paid the difference in cash. Journalize the entry to record the purchase of the truck. Okay, so let's just timeline this out. Okay, so let's see here. In 2013, they acquired a truck for $385,000 with a useful life of 6 years. So that's 2019. Let's see, that's 14, 15, 16, 17, 18. All right. So 385,000 is what he paid. Useful life of 6 years. Units of production is how it's depreciating. So in 2013, used 182,000 miles. In 2014, 263. In 2015, 254. And in 2016, 62,000. Okay, so this is 2013, this is 2014, 2015, 2016. I should make this out here, right? I got this all messed up here, right? Let me do it like this. So in 2016, that's all that's really important, right? Because this should be at the end, not at the beginning, all right? So this should all be kind of like bumped over, right? But anyway, so they used 62,000 miles in 2016. At that point in time, a new Freightliner, which cost $422,000, had a trade-in of $243,000 and paid the difference in cash. Trade-in and paid the difference in cash, which is 179,000 in cash. So I have 179,000 in cash, and so I have to journalize the entry to record the purchase of the new truck. Okay, so now that I understand, I have an idea as to what I'm looking at. Okay, by creating the timeline, I see I buy the truck. Units of production, 6 years, buy it at 385,000. I use it. These are units of production. So I'm going to have to depreciate using units of production for this amount, for these amounts. So I'm going to have my balance sheet is going to show my truck for 385,000 less my accumulated depreciation, right? At some amount up to the $62,000 used, which will give me my book value. Okay, so that's what I'm going to need to do with that all the way up to that point in time. So basically, this is a units of production depreciation method. But then when I have that figure, now I'm going to take into consideration that I have the purchase at 422, and I have a trade-in of 243. And I have 179,000 in cash that I used to purchase that new Freightliner. Okay, and we need to record the journal entry. So I'm going to erase all of this. And work through the calculations here. Okay. So calculating my depreciation, I have 385,000. Okay, and its useful life is, let's see here. Nope, it is. Oops, right, erase this here. And I'm using it for 1,000,005, right? So I divide that into that, and that gives me 0.2 cents per mile. Okay, so for 0.2 cents per mile for units of production as my depreciation expense. Okay, 385 divided by 1,500,000. Wait a minute, hold on, back up. I did that wrong because I didn't take into consideration the residual value. Okay, so I have 385,000 less 85,000 for residual value. Okay, so that's $300,000. Right, so I take my 300,000 and I divide it by the 1,500,000, and that gives me 0.20. So I still end up with 0.20 per mile. Okay, not if that was 385,000, that would be like 26 cents or something like that. Okay, so I know that's not right. So I end up with units of production of 20 cents per mile. So for year one, I have 182,000 miles times 20 cents a mile, and that's 36,400. For year two, I have 263,000 times 0.20, and that ends up being 52.6. For year three, I have 254,000 times 20 cents, and that ends up being 50,800. Year four, I have 62,000 times 20 cents, and that equals 12,400. Right. So now let me see what my total is. That's 0, 0, 12, 8, 9, 10, 11, 4, 9, 4, 15, 15. Oops. 6, 10, 12. Oh, 22. There we go. That's 22, 8, 10, 12, right? 1,522,000. Right. So that's my total depreciation, right, of 1,522,000. Okay, so that's all of that math, right? So now let's do I'm erasing this, and now we need to figure out the the trade-in, right? So I have a trade-in value. So I have, get this right here. All right. So remember, we're trading in, okay? So we're exchanging one truck for another. So what's my trade-in value? My trade-in value, now the cash, it does not, even though the value of the original truck is 422,000, okay? That is not what is coming into play just at this moment in time. Neither does the cash. Okay, so even though you have this information, don't jump to conclusions real quick. What you're doing here is you're replacing one asset on your books with the other asset. So if my trade-in value is 243,000, okay, I have to then figure out the different, think of it this way. In that, yeah, I have this and it's worth this much. Okay, forget about how much I'm buying the new vehicle for. Forget about the additional payment in cash, right? That doesn't come into play when I'm replacing one asset with another asset, okay? Now, if I had just gone and paid straight cash, well, yeah, that's what I'm saying the value is, and I would only be getting, you know, the 243,000 for my old vehicle, or that's the way maybe you want to think about it. You know, here's my vehicle. I have a, you know, a book value for my truck, but you know, when I go to trade it in, this is how much I'm going to be able to get for it, okay? And just treat it as, think from the mental perspective of that's just, you know, how much cash I would get, all right? So I have my book value, which I know my cost was 385. I have an accumulated depreciation of, oops, too many zeros there. That was 152200, right? So I have 152200, okay? So I'm subtracting out my accumulated depreciation, which that from that gives me 232,800, and then I subtract that from that, which gives me a gain of $10,200. So the gain on the sale or trade-in, right? We're going to call it gain on sale, even though we're trading it in, all right? All right, so that's how that's going to look. So let me erase this, and I'm just going to rewrite it again so we can quickly summarize it. All right, so I have my trade-in of 243, and I have my book value, which has my cost of 385 less my accumulated depreciation, which is 152200, and that means the difference between those two is 232,800. So my gain on the sale is 10,200. Okay, so now that we know what the gain is, now we have to actually make the journal entry. All right, so now in actually making the journal entry, remember this is going through this here like 3-step process, right? You know, one, what am I getting? All right, well, one, I'm getting a new truck. So, oops, let me do that in black. So one, I am getting a new truck. So I debit my truck for 422,000. So this is where this now is when this information comes into play. Okay, right? Now is when this information comes into play. Right? So I have to take my old, my old truck off the books. Okay, so what do I have? Well, I have a debit of 385,000. So I credit my truck old for 385. So this is like step number 2. I'm taking the items off of my books. I'm getting rid of them. Okay. Now realize that this truck new would be a new account. It would be a different general ledger account. Okay. Since I have accumulated depreciation, you know, that's a credit. That means I have to debit that. Okay. So number 2, you know, what I'm getting rid of. So I'm going to debit my accumulated depreciation for 152200. What else am I doing? Okay, what else am I doing? What else am I getting rid of? Well, I'm getting rid of cash, right? So 2, I'm going to credit my cash for $179,000. Okay, remember this is, you know, when I'm looking at number 2, you know, it's the effects on my books. Okay, so what am I getting? Number 1, I'm receiving the truck, so I put it on my books. Number 2, what am I giving up? What am I taking off of my books? And part of that is cash. Okay, and then number 3 is, you know, my debits less my credits, right? Which ends up being the 10,200, right? And so the difference is a credit, and this is, they're calling it a gain on exchange for 10,200. So my debits equal my credits, and that's it for that particular journal entry. Okay. If you I'm going to tell, you hear me say it again and again and again. If you don't, go back and watch the theory videos. If you still don't understand it, you know, um, rewind, pause, rewind, rewatch the videos. Okay. But it does behoove you to actually go through exercise 838B, 39B, and now 40B. Even though they're doing similar things for each one, there's a slight progression from one to the next as to an additional level of treatment. I mean, in the first one, we just disposed of an asset. Okay. In the second one, um, let me back up the right. So we just had the straight line depreciation on that asset. Um, On that one there, we disposed of the asset, and this one here, we're trading it in. So each one is just a little bit more higher level of complexity, but the basic overall concept and theory is still the same exact thing. One, you have your book value, you have to calculate your accumulate depreciation. Two, you record what you received, you record what you're giving up, and three, you record the difference. Okay, and you make the journal entry. It just, it sounds easy when I'm just saying it, and it really is if you understand that concept and know where to pull the information from. So, go back and watch those videos again if you have to. Pause and rewind this video and watch it again. And if you still don't understand something, feel free to contact an instructor. Okay.